Hello, everyone. Good evening. It is almost 11 p.m. here in New Jersey. So the New York stock market is closed. Those hours are done for, right? Not until tomorrow morning at 9:30, as we know. So here's the issue that I've been concerned with for a while. I have shares, and then I don't know what call to sell against my shares. Why? Because I'm looking for yield. I used to just look for buy low, sell high, but that doesn't really help me because I'm always off at, I'm always buying at the wrong time. I'm always selling at the wrong time. I really don't know what I'm doing when it comes uh to prices, to price movement. And I want to avoid that noise. What I really want to focus on is the yield that I get based on owning the shares. Kind of like a landlord. I want to rent out my shares for a specific amount of time, and I want to know what's the best yield I'm going to get um, on on the strikes that I choose. So here I have shares. Let's say I bought shares, well, let's say here for around 33 and a half bucks. And then I want to sell some calls against them to get some kind of yield. Well, which one should I sell? Should I sell the 34, the 35, the 36? Well, if I sell the 36, yeah, I can hand over my shares at 36, but the probability that I'll be able to walk away and keep my shares for next week, I'm going to use this delta here as a proxy for the probability of something happening. So here, if I'm going to hand over my shares at the end of the week, there's a 12% chance of that happening. Well, should I go for maybe the 34? Well, the 34 has a 43% chance of happening, and that's why it's compensating me more. Great. Well, rather than do the math for all three of these, maybe the 34, 35, and 36, and then look out to maybe next week's, the same risks might give me a better yield for the week. We know that, excuse me, the further we go out in expiration, the more premium we should be collecting. However, we want to compare apples to apples. So we want to compare this weekly yield. If we look at the average weekly yield over 11 days, is that better than over 3 days? Or maybe if I look at 18 days, is that better for the same risk? Let's say, alrighty, we were looking at a 12%. Here, this is giving me a little over a half a percent, but I got to wait 18 days. Whereas this one, for that 12 percenter, well, it's giving me about a third of a percent um, for the same risk, but it's over 3 days. So rather than do this manually, what I wanted to do was to develop a program that would search for this and tell me what the correct answer is. So what I'm going to do is just run this little script that I came up with. Whoopsie. We just lost Thinkorswim. Oh, there we go. And what I'm going to do is just put this in here. Let's see if I made sure that I remember the path for it. Whoops, I believe it's OneDrive. It's under the desktop, and then it's called option scanner. .py. All right. What this is going to do, it's going to ask me for the ticker symbol that I'm looking for. And then I'm going to look to get in or get out of my shares. So suppose that I own the shares and I'd like to get a little greedy. I'd like to sell a call against it, but I don't really want to hand them over at a lower price than what it's currently at. I want to hand them over at a price that is even higher. So I'm going to say, hey, listen, you know what? I want to go higher. I want anything that has a 70% chance of not happening, not going through that strike. Remember, we're going to use the delta as a proxy for probability. So here I'm saying this is the maximum delta. It's going to look through this week's option chain, and I want to make 1% off of that strike price. And I'm going to look out for the rest of the year. Let's see what it comes up with. Oh, and I like to keep my spreads tight. Let's see if it comes up with anything. All right, it came up with one. It's telling me that, I mean, the markets are closed. This is so unrealistic. But this one has a small delta, and the premium is 12 cents, and the strike is 36. So now I'm going to compare it to here. Yeah, so you can tell that there's some error. Obviously, the delta here is off, and this is something that we are missing in this program because this program is a freebie. This one is bringing data in from Yahoo Finance, which does not have the deltas. It is assuming to calculate the deltas, what your risk-free rate of return is going to be, as well as the implied volatility. It's keeping it set. If we can bring this data in, for the next step would be to bring it in from a broker, then I won't need to estimate this delta because you can tell right now this delta is significantly off from here. But having said that, what this is telling me is that, all right, look, Yasser, if you want this, the user is now being told this is your optimal strike that you want to go for. You bought the shares, you're going to sell the 36 strike against it. It is going to give you the best possible weekly yield. All right. Now, I'd like to try to find something that has more. And whoops, let's just copy this because my typing skills are going to be awful and I'll probably screw it up. All right. So let me look for something else. Let me look at TQQQ. I like looking at triple leveraged instruments. And let's say I want to own shares. So I don't have any shares, let's say. I'm going to look at the puts. I want to get in. I want a small chance of getting the shares. Only if it drops really by a lot do I really want to pick up these shares or get assigned these shares. So here I'm going to put a delta of 25%. Right, the 25 delta, and just assume that 25% chance of my owning shares at a certain point. Remember, we are going to tell it if it's the minimum or the max. We want to look at this, we want to look at deltas of 25 and below, and I want to make about 1% off of those, off of that strike price. Okay, great. And again, I'm gonna look out for the rest of the entire year, and I'm going to keep these spreads kind of tight at 10 cents. Okay, now let's see if it comes up with anything. Great. So now it's telling me here, you're going to look at this week's, and you could sell the 80, the 79, or the 78.5. And the deltas are all within this 25 delta that I asked for. It gave me a 15 delta, it gave me a 9 delta, it gave me a 6 delta. And it's telling me that these total yields are, of course, low. Why? Because today is June 30th and the expiration is July 3rd. It gives you this weeklyized, if you will, yield. So it's going to extrapolate the total yield over 3 days into 1 week. And it also gives you the expected utility yield, meaning it's multiplying the weekly yield times the absolute value of the deltas. The deltas are negatives because these are puts. So you're going to multiply this number times the weekly yield to get your expected utility yield. Meaning if you do this over and over and over again, this should give you the highest yield. And what we see here is it's telling me that, all right, sell it. It's going, if you want to get in based on this criteria here, then the $80 strike is your best bet. And so what I'm looking for here, I'm going to just double check here, and then I can go manually and I can do this. I can look at the 80, and here I can sell the 80. And just like it said, we were looking for something that had a delta of 25 or less. Again, this delta calculation is an estimation, and so it won't be accurate, and as accurate as, as what your broker is going to provide for you. And so what we're seeing here is it's telling you that, all right, for about 47 cents over $80, you're getting about 0.5%. And this would be the optimal one. Everything else here is above that 25 delta. So we're looking at only from here all the way down. So the 80, the 79, the 78, 50, and so on, all the way down to the lowest possible strike price that we have. And you can tell here there is really no premium left. And so it went through all of these strikes, and it went through all of the rest of them up until the expiration date, my latest expiration date that I wanted it to look for, which was the very last day of the year. So we're going to look, the program is going to look all the way into here. It's going to look at all the deltas. So can you imagine going through all of these? All right. Now, you're going to say to yourself, this is giving me a higher yield than this one, of course, because this one has only 3 days left, whereas this one has almost 6 months left. But what we're looking for is we want to look at what would be the weekly yield. So in this case, this is telling you, don't even consider any of the ones that are farther out. Look at just this one. It is telling you right now, if you want to get in and you want the highest yield based on the risk that you're providing, hey, go for this strike right here. It is going to give you a weekly yield of about 2%. Again, there's only 3 days left there are 3 days left until expiration. And so we're going to do this. And this way, we don't have to really worry about, well, what kind of greed am I looking for? What kind of fear am I going to have? I don't know what to do. And so this eliminates, or at least drastically reduces, the indecisiveness that a trader might have. So hopefully you'll enjoy this program, and there's still more to come.